Today, we're going to be talking about home equity lines of credit, also known as HELOCs. And while we're not going to talk about any specific brand, because banks and financial institutions make changes and alterations to their product lines all the time, we are going to talk about how home equity lines of credit work in general, some of the different types of home equity lines of credit that exist, and some of the pitfalls that people fall into when setting up their home equity lines of credit so that hopefully you don't make those same mistakes as well. Like all things, not all home equity lines of credit are created equally, so understanding the differences between them can sometimes play a very critical role. Home equity lines of credit allow you to get access to some of the equity that's built up into your property within certain exceptions. It essentially acts like a regular line of credit in that it operates like a revolving door that you can put money on it, take money against it, put money on it, and take money against it. Where it differs from a regular line of credit, however, is that a regular LOC isn't secured to any one given asset, meaning it's an unsecured debt, whereas a home equity line of credit is registered against the title of your home. And this has some important implications. For starters, HELOCs typically allow you to have much larger limits. Because it is registered against the title of your home, you have a significantly larger incentive to make sure you pay that loan back, particularly since if you don't, they can come and take your home. This makes it a much safer bet for banks. But it also means that because it's a safer bet, you'll likely end up seeing a significantly better interest rate on your home equity line of credit than you would otherwise see on an unsecured line of credit. Let's look at some examples as to how home equity lines of credit work. Let's say that you had a home worth $700,000 and you had a mortgage on that home worth $400,000. That would mean that you roughly have $300,000 worth of equity built up into this property. And some people believe that if they get a home equity line of credit, that they're going to be able to access that full $300,000. Which isn't true, because when lenders are qualifying you, they're actually required to qualify you with two other ratios in mind above and beyond all the rules and regulations put in place to make sure that you qualify for the mortgage in the first place. The first ratio is that in order to set up a HELOC, you need to have at least 20% equity built into the value of your property, or more specifically, you cannot have a loan above 80% loan to value. The second ratio is that at any point, the limit on your home equity line of credit cannot exceed 65% of the value of the property. So in this example where you have a $700,000 home and a $400,000 mortgage, the 80% loan to value is really $560,000. That is the capital limit, meaning the true home equity line of credit limit that you can set up is roughly $160,000. The difference between $560,000, the 80% limit, and the current mortgage value. Now in this example, if this person went out and got a home equity line of credit with a limit of $160,000, it does not mean that they need to carry a balance on that HELOC. In fact, they won't pay interest on this until they actually start utilizing the home equity line of credit, although there may be monthly account fees associated to the account. Let's say this person who owns a $700,000 home actually didn't have a $400,000 mortgage. No, instead they had no mortgage at all. They owned the property free and clear. How big of a home equity line of credit could they get? Well, in this case, the 80% loan to value refinance limit still exists, but they're actually capped by the second ratio before they can even get there, the 65% maximum home equity line of credit limit, meaning that the largest home equity line of credit that they could get is a $455,000 line of credit. Now what they could do if they're looking to refinance up to that $560,000 refinance limit, that 80% loan to value, is get a traditional mortgage for the remaining 15%, meaning a 65% home equity line of credit limit and 15% for that traditional fixed or variable mortgage, so they can total 80%. Let's look at one more quick example. Let's say that once again that the person owns their home and it's worth $700,000. But this time they actually have a mortgage of $560,000, meaning they're already at the cap, the limit that they would be able to take out. How much of a home equity line of credit would they be able to qualify for? Well, in this case, you probably guessed it. The answer is $1.
Dude.
Because they're already at their cap. And that's where you might have to step away from a regular home equity line of credit and go to something a little bit more sophisticated. A readvanceable, subaccount, home equity line of credit. In one of these types of mortgages, your mortgage is actually broken out into three different parts, with the first part being your home equity line of credit, which, if you're using this example, would start at a single dollar for its limit. The second is a non-readvanceable subaccount mortgage, which is usually worth 15% of the value of your property, and the other is a readvanceable subaccount mortgage worth roughly 65% of the value of your property. Now, for the 15% non-readvanceable subaccount mortgage, that behaves and operates like a regular mortgage. It could be fixed, it could be variable, it will have a specific term, and as you pay it down, it eventually reaches zero and is gone forever like a traditional mortgage. But the third part, the 65% readvanceable subaccount mortgage, is really the portion that we want to be paying attention to. This portion is much like the 15% portion in that it could be fixed, it could be variable, it's associated with a term, and is like a regular mortgage in that as you pay it down, it eventually becomes zero. But it differs that as you pay down the mortgage and the principal decreases, every single dollar that principal decreases goes to increase your home equity line of credit limit by that same dollar. Not the balance, but the limit. So this means that as you're paying down the readvanceable subaccount, that your home equity line of credit limit is increasing by the same proportion, meaning that someday, once you've paid off that entire subaccount, you'll have a home equity line of credit limit worth 65% of the value of the property. Now I'm going to give you a quiz, but before I do, here's some additional information to help you. In this example, the 15% non-readvanceable subaccount and the 65% readvanceable subaccount both have their own principal and interest payments, meaning that your monthly payment is actually a combination of those two amounts. If you were trying to make additional prepayments against your mortgage to pay it down faster, with the additional goal of trying to reduce your overall monthly expense, the overall monthly amount that you pay towards your mortgages, which of the two subaccounts would you pay off? The answer is the 15% non-readvanceable subaccount, because as you pay it down and eventually it reaches zero, the payment associated with that subaccount disappears forever. And because it's the lowest mortgage amount, it's only 15% of the value of your property, it's the easiest to pay off. Here's question number 2. Let's say once again you have some additional money that you're looking to put against your mortgage to pay it down faster and save some interest. But that additional money is actually your emergency fund that you set aside in case something goes wrong. Which of the two subaccounts should you pay off? The answer, of course, is the 65% readvanceable subaccount, because as you pay down that subaccount, every single dollar that you pay towards that mortgage goes to increase your home equity line of credit limit by the exact same amount. So if you ever enter into a situation where you need to access that capital to handle an emergency, you have the home equity line of credit within which to do it with, allowing you to save interest on your mortgage until such time that you actually need to utilize the capital. But here is where some people might get caught in the dark side of HELOCs, because most lenders, not all, but most of them, do strictly enforce the due on death clause, meaning that if you own a home with a spouse or partner and there is a home equity line of credit attached to the property and one of you dies, the home equity line of credit is instantly frozen, meaning you no longer have access to that equity. So at a time that you potentially need it most banks and financial institutions are going to freeze that account so that you can't withdraw on it. But like I said, not all banks enforce this equally, meaning the bank you choose to go to get your home equity line of credit could be critically important. Now, another reason why you might want to be careful which bank you get your HELOC from is that home equity lines of credit are registered against the title of your property using a collateral charge. And this is unlike a typical residential mortgage charge that your traditional mortgage would be using. Collateral charges are important for two reasons. The first is that not every mortgage lender is able to handle these types of title charges, meaning that at renewal there could be less lenders able and willing to compete for your business, resulting in potentially slightly higher mortgage rates on renewal. But it's these types of charges that are necessary in order to have the home equity line of credit in the first place, because it's this charge that allows you to take money on and put money off again, which is why in previous videos, if you've heard me talking, you don't want an unnecessary collateral charge. If you're going to have a collateral charge on your property, it better come with a home equity line of credit. The second reason is that collateral charges link all of your debts at that particular financial institution together. Meaning if you miss a Visa payment, they can go after the equity in your home. If you miss a car payment, they can go after the equity in your home. For this reason, you'll often hear me recommend that if you're going to get a home equity line of credit, that you do it at a bank or a financial institution that does not have any of your other debts associated with it. Otherwise, if you end up finding yourself in a situation where you're starting to feel some substantial financial strain, you may see your debt problems bleed into and start affecting your largest asset, your home. Some substantial financial situation. Man, try saying that 10 times fast. Here's a few additional things that you should know. As I mentioned before, home equity lines of credit often have significantly lower rates than credit cards and unsecured lines of credit, making them a great option for you to consolidate your own debts at will. The problem is that the rate that you're paying on your home equity line of credit is an adjustable rate mortgage, meaning that as rates go up, so too does the rate on your HELOC, and as rates go down, so too does the rate on your HELOC. Now, fortunately, any balance that you're holding on your home equity line of credit is interest-only payments. And this proved very beneficial throughout the pandemic for many of the people who are relying on them. because as they lost their job or as they had financial problems, they were able to use their home equity line of credit and only make these small interest-only payments until they were able to get back on their feet. The bad side of this, though, is that because the payments are so small, if you're not disciplined enough, you may find yourself in a situation where you're in debt forever. Home equity lines of credit are a lot like fire in the sense that they're a tool. You can cook your food with it, but you can also burn your house down. So if you're going to get a home equity line of credit, do so responsibly. Now, if you found this video helpful, please like it and share it with someone that you think might also benefit from it. And if you could, subscribe to the channel, hitting the bell notification so that you're alerted when new videos come out.